you hear me talk about operate. I operate real estate, and that may be a foreign term to you if you're used to single family or just buying a passive real estate investment. Operate equals manage. Operate means to manage. It's the act of running the business of a particular real estate asset. Welcome to the Nick Huber Show. I'm Nick Huber. Today we're going to discuss some must-know terms if you're going to listen to this show, if you're going to talk to any bankers, if you're going to talk to an investor, or you're going to hang out on real estate Twitter. These are some things you need to know what they mean to understand what I'm talking about, what a lot of my guests are going to talk about, and frankly, unfortunately, the lingo that everybody disguises their language with as they discuss real estate. It can sound like Spanish. I'll admit it. It took me a long time to learn a lot of these terms that bankers use, that debt brokers use, that investors use, and that other GPs, general sponsors, use when you listen to them talk about their deals. Now, the first thing, the almighty factor in real estate is net operating income, NOI. What is NOI? And net operating income basically is a standard of profitability for a property, and it takes out any non-property related expense, meaning debt is taken out, how you're structuring the deal is taken out. It doesn't necessarily correlate to cash on cash, because cash on cash determines, or cash on cash returns, COC, if you're looking at it online, that is the actual cash on cash return that you get from a property. Now that depends. Cash on cash depends on leverage, debt service payments, capital reserves, AUM fees, any deal related fees, all these different things that are variable. As we go through this podcast, you're going to hear a lot of different ways to structure deals. Now, net operating income stays the same. It is basically your top line revenue minus your property related expenses. And it doesn't matter who owns it. It doesn't matter what kind of debt is on it. It doesn't matter all the variables. So, I mean, yes, it is affected by management. And you can increase your net operating income, and you can decrease your net operating income if tenants move out and they stop paying. So I won't say that you can't impact it with good management, but it's a term that is thrown around and used by a lot of real estate operators and bankers and appraisers, because it's a way to value a piece of property to anybody. Meaning, if you say a property has $80,000 of net operating income, I know that it depends on how I structure the deal and how cheap I can get debt and all these other different things, how many partners I have, who gets what, of where the cash is going. But net operating income is that constant. It is that, think of it as bottom line profit or loss from real estate operations. Now, what expenses come out? This is things like a management fee. A management fee is what you pay to a third-party company, oftentimes, if you hire one, unless you do it yourself. A management fee is what you pay to a third-party company to oversee an asset. They're the ones that answers the phone. They're the ones that do the leasing. They're the ones that, hire somebody to come fix the toilet if the toilet's broke. Now, we actually charge ourselves a management fee because we have some partners in a deal. So Bolt Storage, Nick Huber, I may own 50% of a deal, but partners might own the other 50%. So if I'm going to do the work to manage the property, we have a separate company that charges the entity a management fee. Net operating income is looked at by the appraisers to judge how healthy, how valuable, all these different things. Now, cap rate. A cap rate is very important. This is the second most important term that we're going to discuss throughout this entire podcast, and that is the net operating income divided by the value. If, let's say it makes $80,000 a year in net operating income, and you value it at an 8 cap. Now, it's a math problem. The the net operating income divided by value equals the cap rate. So if this property, say, is worth $1 million, if an $80,000 a year net operating income property is worth $1 million, that is an 8 cap. Meaning, if you spend $1 million on this property and it's unlevered, there's no debt on it, it will generate $80,000 a year in net operating income, or 8%. That's the way I think about it. What's the yield on this thing if it's unlevered? And that's another one of these important terms, unlevered yield. What's the unlevered yield on a property? That means if I just pay all cash for it, what's it going to yield me as a return percentage, which is the same as cap rate. So if $1 million purchase yields me $80,000, that's an 8% return or an 8 cap. So eights can be used, or cap rates can be used as percentages. Now, there's a lot of nuance to cap rate because it depends on who's operating it, and it also depends on time frame as that return percentage. So let's say you're looking at a property that is on the market. Now, the in-place cap rate means the last 12 months. What happened? That's in place. Right now, this is the cap rate. The net operating income divided by whatever you might pay or whatever they're asking. That's the in-place cap rate. There's also going-in cap rate. The going-in cap rate is the first 1 year of operations. So a going-in cap rate for me as a buyer is different than the going-in cap rate for somebody else. It's also an estimate. It's a projection based on pro forma. And the pro forma is the cash flow projection month by month, how much cash we're going to make. Underwriting is another word for creating a pro forma. We're going to underwrite a deal. We're going to figure out how much it's worth to us. We're going to make a bunch of educated guesses on how profitable a real estate property is. So if you go through underwriting, trying to figure out what it's worth to you, trying to figure out what you're going to offer on it, you're making a lot of assumptions. You're making a lot of guesses. You're making a lot of projections into the future on the pro forma document. And so your going in cap rate will be your unlevered yield year one. If I'm going to pay $1 million for a property, but I think I can only make $40,000 in net operating income the first year, that is a 4 cap, because 40,000 divided by 1 million is 4. But if I think I can raise revenue and decrease costs, and I think I can really do well, and maybe it had $80,000 of in-place net operating income or an in-place cap rate of 8%, I may be able to increase net operating income to $100,000 or increase it to a 10 cap. It's a 10 cap for me, going in 10 cap. There's also projected cap rate. There's stabilized cap rate. There's all these different terms that people use for cap rates at different time periods. There's a lot of nuance to the term cap rate, but we use it all the time. If I'm going to buy something at an 8 cap, you take the amount of net operating income that it's doing, divide it by 0.08, and you have the value that you have. Now, the next one is the real estate actors. Who is organizing a real estate deal? The person who's putting it on, the sponsor in real estate private equity, is called a GP, general partner, or a sponsor. That's the person who's finding the deal, organizing the deal, executing the deal. They're doing the work, and that's what I am. You're looking at Nick Huber. You're listening to Nick Huber. I am a sponsor. I'm a GP. I'm a general partner. That means that I don't necessarily put my money in. I can be an LP in my own deal as well. But for the most part, I am organizing the deal. Okay, I'm doing the work. Now, the LP, the limited partner, they are just investors. They put their cash into a deal. In real estate private equity, GPs raise money from LPs. Sometimes there's a co-invest. A lot of times in our deals, we have a 10% co-invest, meaning if we need $100,000 total to put a deal together and we have a 10% co-invest, I have to put in $10,000 or 10% of the total cash needed. So it's complicated. Are you still with me? I hope so. But anyway, I am the sponsor. The investors are the LPs, and we do something called a real estate private equity structure. We'll talk about that in the next episode. That's very important. Now, unlevered yield is another term that is the same as cap rate. It's a percent return on a deal if it didn't have any debt on it. Now, debt service, you hear the term debt service a lot. This is the term for principal and interest payments on a loan. Any expenses that are related to a loan. Most commercial real estate has a loan on it. Most of it's levered. So you have what's called debt service. Now, there's a term called lease up. This is the time period that it takes to get tenants to rent your space. If you're buying a distressed property, if I'm buying a distressed self-storage facility, it may have only 70% of the units rented, or 60% or 50%, or we've actually bought some that are in really poor condition that only have 5 to 10% of the space listed or actually rented to tenants. So what we have is a lease up period, a time period in months or a time period before we reach our maximum occupancy of in ideal world for me, it's 92 to 93%. So lease up is that time period while you're getting new customers. Speculation, I talk about that a lot. There's a difference between cash flow investors and speculative investors. Cryptocurrency is speculative. It doesn't serve a purpose right now. It's a store of value. So you buy cryptocurrency hoping that it's more valuable in the future and somebody else will give you more money for it. not a lot of utility, right? People can be speculators in real estate too. You hear spec homes being built, meaning they're building homes before they were purchased by anybody else or before they've been sold. So they're speculating on their ability to sell the home later. Real estate plays can have speculative natures as well. So you hear me talk about operate. I operate real estate, and that may be a foreign term to you if you're used to single family or just buying a passive real estate investment. Operate equals manage. Operate means to manage. It's the act of running the business of a particular real estate asset. Now, operating a self-storage facility involves answering the phones, getting leases signed, sweeping out units, getting somebody to mow the grass. So most GPs, general partners, sponsors, they either self-manage through a different company that they own and they operate the asset through that, or they hire a third-party manager to operate their asset. So we hear the word refi a lot, refinance. That's something that you need to be aware of as well. That means you're going back to the bank and putting more debt, different debt. You're recapitalizing an asset. You got an original loan to close on a real estate property when you bought it. A refi means you're going back to the bank, different bank, whoever, and you're getting a different type of debt with different terms. You're going to get new debt to pay off that old debt and get different leverage on the asset. Now, there's a cash out refinance. That means you refinance a property and there's more cash than you originally had in debt. So the new debt actually pays off the old debt and there's extra. That's a cash out refinance. You can pull cash out doing that. You heard me mention asset class. There are many different asset classes of real estate. I talk about them all the time. There's self-storage, that's one asset class. There's mobile home parks, that's one asset class. There's industrial real estate, there's multifamily, there's single family, there's medical office, there's cemetery, there's RV parks. There's tons of different types of asset classes. Now, all of them have their advantages and disadvantages. And we're going to spend a lot of time on this podcast talking about the different asset classes, how they, interact with each other, the pros and cons of each, and what you might want to go after. Now, there's a term called debt service coverage ratio, DSCR, and it's the relation of net operating income to the total debt service obligation that you have on a property with principal and interest. So if your debt service payments are $35,000 a year and your net operating income is $35,000 a year, you're break even. Your debt service coverage ratio is 1. That's not good. If your debt service every year is $50,000 and you make $100,000 in net operating income, that's pretty good. And it's double. 100,000 is twice as much as 50,000. So your debt service coverage ratio is 2. Now, most banks, they have a minimum of debt service coverage ratio that they like to get comfortable with. It's a stress test. When somebody asks you what your DSCR is, your debt service coverage ratio, they may be asking you what kind of risk they're taking on, right? The relationship between net operating income, how much cash the property makes, and the debt service that you have to pay. So those are some basics. We're going to talk about a lot more terms, but if you're confused about net operating income and cap rates, I don't blame you, but I do have a couple free resources that I'm going to guide you to go check out right now. If you go to sweatystartup.com/courses or just sweatystartup.com, there's a button at the top called courses. I have a free course on NOI and cap rates, and I have a free course on debt service and cash flow. Each one has about 10 questions, some cool videos to watch, some quizzes, and some different sections that'll teach you about the nuances of net operating income, how it's calculated, how it changes with operations, and cap rates, the different types of cap rates, the nuances, how they relate, how low-risk assets have different cap rates than high-risk assets because investors need to be compensated in different ways. It's very complex. And also debt service, how debt service changes the amount of cash flow that a property has. I have 2 really cool mini courses. You can take them both in about a half an hour. You'll get a lot smarter and you'll know a little bit more when we go forward and discuss a ton of this stuff on here. And again, that's sweatystartup.com and click on the title menu bar that says courses. And you can take those 2 things. They're free. And there we go. That's it. This crash course, you may need to rewind and listen to this again. I did my best to clearly and concisely give you some of the basic terminology of real estate. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at U.S.-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring